Welcome to the TAS online courses IPSAS vs IFRS Part 2. Now the key differences between IPSAS and IFRS are the ones that follow. Under IPSAS, service potential is now being included as part of the definitions and recognition criteria. Many of the assets and liabilities of entities within the public sector are acquired or incurred as a result of the entity's service delivery mandate. For example, heritage assets and parks maintained for public access. IPSAS introduces the concept of service potential into the definition of assets, liabilities, revenue, and expenses. Service potential is also a supplementary recognition criterion to account for items that do not result in the inflow or outflow of economic benefits, where an item either contributes to or detracts from the entity's ability to deliver its services. Consideration of exchange versus non-exchange transactions. Non-exchange transactions are those transactions where an entity either receives value from another entity without directly giving approximately equal value in exchange, or gives value to another entity without directly receiving approximate equal value in exchange. Within the public sector, non-exchange transactions are very prevalent. Examples of non-exchange revenue transactions accounted for under IPSAS 23 would be taxes and levies, donations and grants, as well as fines. Impairment of non-cash generating assets. In light of the assets recognized based purely on their service potential as opposed to economic benefits, IPSAS also caters specifically for impairment considerations for non-cash generating assets. IFRS assumes that all assets will be cash generating, whereas IPSAS assumes that the majority of a public sector entity's assets are likely to be non-cash generating. Let us consider recognition of revenue from government grants. IPSAS focuses on whether there is entitlement to the revenue from government grants, even though there may be restrictions on how the funds are spent, or an obligation to meet certain conditions which is recorded as a liability. The distinction between restrictions and conditions is crucial in determining whether or not to recognize revenue from a non-exchange transaction, and this is covered under IPSAS 23. As a result, government grants are generally fully released to income earlier under IPSAS than under IFRS. Reporting of budgets versus actual. With the increased focus on stewardship, service delivery, and budget management in the public sector, IPSAS requires a comparison of the actual financial performance of an entity with the approved budget of that entity, where the budget is publicly available. For this, there is no equivalent requirement in IFRS. Also, in IPSAS, there is an elimination of private sector specific concepts such as IFRS 2, share-based payments, IAS 33, earnings per share, and also IAS 12, income taxes. Let us consider the roadmap to IPSAS adoption. The roadmap considers firstly where the company is in terms of its current reporting framework. Is it cash basis or accrual basis? If the company is currently reporting under cash basis, they could choose one of two ways. Either move to modified accrual basis and then ultimately to IPSAS accrual basis, or move to IPSAS cash basis first and then from there move on to IPSAS accrual basis. If the company is on an accrual basis or a modified accrual basis, they could consider directly moving to the IPSAS accrual basis. The point is, at the end of the day, the ideal is IPSAS accrual basis. Now the following is the implementation path proposed, a generic one. There is project initiation, approval, training, gap analysis, and the strategy for implementation as the first step. Then conversion 1, if it's cash IPSAS, then consider updating systems, updating controls, manuals, training, and pilot IPSAS. Then if it's conversion 2, the accrual IPSAS, there is a 3-year period in which the company can use to adopt IPSAS fully. In that period, there is also training and updating that will need to be done. Then ultimately, embed the system. So integrate, review, change management, and train key personnel in ensuring that they know how to account for transactions under IPSAS. Conversion impact and challenges. In the current environment, there are challenges that are being faced with regards to implementing IPSAS. These range from political executive support, legal framework support, accrue accounting know-how or capacity building, staff capacities to reform, IT system support, registration and measurement of assets and liabilities or the opening balance sheet. These are challenges that a company would need to overcome in implementing IPSAS. Should you have any questions, please do not hesitate to contact Training and Advisory Services. Thank you for your time.